Markets head into Friday with a mixed but fragile tone as investors continue to balance resilient risk sentiment against a backdrop of elevated geopolitical risk and shifting central bank expectations. The dominant macro theme remains the Iran conflict and its implications for energy markets, with reports of potential U.S. military action and ongoing Strait of Hormuz disruptions keeping oil prices elevated and reinforcing global inflation concerns. At the same time, equity markets, particularly in the U.S., have shown remarkable resilience, with the S&P 500 and Nasdaq pushing to fresh record highs, supported by strong earnings and corporate buybacks, raising questions about whether markets are becoming complacent to geopolitical risk. In FX, the dollar is trading steadier after recent volatility, with price action heavily influenced by developments in Japan. The yen remains a focal point following intervention efforts from Japanese authorities, though the currency has already begun to give back some of those gains as softer Tokyo inflation data provides the Bank of Japan with cover to delay further tightening. That combination of intervention risk and a less supportive domestic inflation backdrop leaves the yen vulnerable, particularly as differentials remain wide. More broadly, the dollar continues to draw underlying support from the combination of geopolitical uncertainty and a more hawkish shift in global rate expectations. Across other currencies, commodity FX is showing mixed performance. The Australian dollar remains sensitive to both global risk sentiment and domestic inflation dynamics, with rising input costs and energy pressures keeping expectations for further RBA tightening in play. However, broader growth concerns across Asia, including weaker sentiment in New Zealand and uneven Chinese demand, are acting as a counterbalance. Meanwhile, the euro is less of a driver today given widespread European market closures, though expectations for ECB tightening continue to build in the background as energy-driven inflation pressures persist. Looking ahead, liquidity conditions are notably thinner, with much of Europe closed for the holiday, leaving markets more susceptible to headline-driven moves. The key risk remains geopolitical escalation, particularly around U.S.-Iran developments, which will continue to drive oil and broader risk sentiment. At the same time, the tension between strong equity performance and rising macro risks will be closely watched, with investors increasingly questioning whether current market resilience can be sustained in the face of persistent inflation pressures and policy uncertainty. That's all for now.